Marc Lichtenfeld claims to know the ultimate passive income play, and that this investment is not a stock, bond, or private company. It's a little-known alternative investment that could hand you big monthly income from oil and gas. And this investment beats real estate by 5 times, gold by 7 times, and silver by 13 times. And it even has the power to turn a $1,000 investment into $100,000 per year for many, many years. I reveal the stock in this video so you don't have to buy Marc's newsletter. Just keep in mind no paid or proprietary info is given away in this video, and it's all guesswork based on clues in Marc's publicly available sales presentation. There's a few stocks to uncover in this video, so we're just going to jump right into things. The main stock being pitched here is a gas and royalty company. A gas and oil royalty is a payment made to the owner of mineral rights, usually a landowner, for the right to extract oil or natural gas from their land. The royalty is typically a percentage of the revenue from the sale of the extracted resources, not the profit. For example, if an energy company sells gas for $1,000 and the royalty rate is 12.5%, the landowner would receive $125. The landowner doesn't pay for drilling or production costs, so the royalty provides passive income. And the royalty company that Marc is pitching is based in the Permian Basin. The Permian Basin is a large oil and gas-rich region in western Texas and southeastern New Mexico. It's one of the most productive petroleum basins in the world, known for its thick layers of shale and sandstone that contain vast amounts of hydrocarbons. The basin has been a key driver of U.S. oil production growth. And the royalty company that Marc is pitching is the Permian Basin Royalty Trust, ticker PBT. The Permian Basin Royalty Trust is a U.S.-based royalty trust that provides investors with monthly income derived from oil and natural gas production. It owns a royalty interest in oil and gas properties located in the Permian Basin of West Texas. The trust doesn't operate the wells itself, but receives a percentage of the revenue from oil and gas sales, which it distributes to shareholders. Permian Basin has been performing poorly for a couple years, and with declining gas prices, I don't see it turning around. Here's more reasons not to buy this stock. First is no growth, just a royalty check. PBT doesn't actually operate wells or expand production. It's purely a passive royalty play. That means it doesn't grow or reinvest, so you're stuck riding the highs and lows of the oil market without any upside from business expansion. Second is distributions can dry up fast. The juicy dividends can look amazing, until they're not. Since payouts depend on oil prices and production levels, they can shrink or disappear quickly in a downturn. Third is aging assets, declining output. Much of the trust's revenue comes from mature wells, and production has been gradually declining. That's a red flag if you're counting on consistent long-term income. Fourth is commodity prices rule everything. PBT is extremely sensitive to oil and gas prices, which are unpredictable and volatile. You're not buying a business with pricing power. You're buying exposure to market swings. Fifth is no real management, no strategic direction. Because it's a trust and not an active company, there's no leadership team pushing for innovation, efficiency, or growth. That makes it a sitting duck in a changing energy landscape. I'm going to reveal the rest of the stocks in about 20 seconds, but before I do that, I want to remind you to click the link in the description to check out Alpha Picks. I reviewed over 100 stock picking services, and Alpha Picks performs the best and actually beats the market easily. If you click the link in the description, you get $50 off Alpha Picks. So go ahead and click that link and take advantage of this amazing deal. Here's what Marc says about his second stock. Become a partner in this oil and gas company. It's a very unique oil and gas company. Just like my number one royalty opportunity, this is not a regular stock. Instead, you become a partner in a company that owns over 50,000 miles of oil and gas pipelines across the country. And oil producers like Chevron, ExxonMobil, and Occidental use these pipelines to get their crude to market. Also, Marc says, this company is like a toll collector for these big oil and gas companies. They use its pipelines to transport their products and pay the toll each time they do. And finally, Marc says, and as a partner in this company, you are guaranteed to get your share of the profit from every barrel that comes through. In fact, it is legally required to distribute all of its available cash to its partners. That's right. 100% of its available cash is distributed within 45 days of the end of each fiscal quarter. That's money that goes directly to you as a partner. In the past 2 years, this company has banked $83 billion in revenues, and it just raised its dividend to a whopping 7.45% annual yield. What's more, it's raised this dividend every year since 1998. This stock I like a lot and would definitely buy, and here's why. First is built like a tank, diversified midstream giant. EPD isn't just a pipeline company, it's a fully integrated energy powerhouse with assets across natural gas, NGLs, crude oil, and petrochemicals, giving it serious stability in a volatile energy market. Second is a dividend lover's dream. With a yield hovering around 7% and a 2-decade track record of annual distribution increases, EPD is one of the most reliable income plays in the entire market. Third is insider confidence at full throttle. Over 30% of EPD is owned by insiders, including the Duncan family, which means management has major skin in the game. And that's exactly what long-term investors want to see. Fourth is rock-solid financials, low risk. EPD sports an investment-grade credit rating, low leverage compared to peers, and over $2 billion in retained cash flow annually, giving it room to grow while still paying out that juicy dividend. Fifth is positioned for the next energy boom. From LNG exports to petrochemical expansions and global energy demand rising, EPD is positioned to profit from America's role as a top energy exporter, without betting the farm on oil prices. And here's what Mark says about the last stock, the ultimate gold income play. Right now, we're seeing a monumental shift in the gold market. Central banks are scooping up gold at the fastest pace since 1967. The last time this happened, it preceded gold's biggest bull market in history. During the 1970s, gold went from about $35 an ounce all the way to a high of $878 on January 21st, 1980. That's a 2,417% gain in just 10 years. And Mark continues and says, once again, I believe royalty streams are a far better way to profit from this new gold boom. Royalty streams allow you to diversify your holdings across several mining stakes, so there is much lower risk than investing in a miner, while the gains can be far bigger than simply buying gold. This company is Wheaton Precious Metals and the ticker is WPM. Wheaton Precious Metals Corporation is a Canadian company specializing in precious metals streaming. Unlike traditional mining companies, Wheaton does not operate mines. Instead, it enters into agreements with mining companies to purchase a portion of the precious metals produced as byproducts from their mining operations. In exchange, Wheaton provides upfront payments and additional payments upon delivery of the metals. Wheaton Precious Metals is up a lot this year, and there's definitely valuation concerns. Overall, I think the stock is a borderline buy, and here's why. First is royalty model equals low-risk gold exposure. Wheaton doesn't actually mine, it streams. That means it buys metal at fixed prices from miners, locking in margins and reducing operational risk, which is great, unless production partners underdeliver. Second is strong portfolio, but limited growth ahead. Wheaton has some of the best precious metal streaming deals in the industry, but the pipeline of new streams isn't exploding. Growth looks steady, not spectacular. Third is cash flow king, with a caveat. The company generates impressive free cash flow, helping fund dividends and new deals. But if metal prices dip, that cash cushion could shrink fast. Fourth is inflation hedge? Kind of. Gold and silver can be a hedge against inflation, and Wheaton gives you exposure to both. The catch? It doesn't always track perfectly, especially when interest rates are climbing. Fifth is valuation is not cheap. Wheaton trades at a premium to other royalty companies thanks to its track record. But at current levels, you're paying up for safety, not snagging a bargain. And make sure to click the link in the description to check out Alpha Picks and get $50 off this amazing service. Also, if you missed my last video, make sure to watch it. There we look at a $2 stock with potential to explode 3,000%.